Welcome to another bar walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we are going to be diving into bar area 2 now, and this is section A of bar area 2. This is an application topic. Calculate the carrying amount of goodwill and other indefinite-lived intangible assets reported in the financial statements, and that would include the initial and subsequent measurement, including impairment, and prepare journal entries. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. Again, in that 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. So make sure you go check that out, and after you watch that, you're going to want to learn more, so make sure you also check out becoming a Superfast CPA Pro member. Pro members get access to the full 10-question versions of these typically 5-question videos. So again, in today's YouTube video, we are only going to go over 5 questions, but Superfast CPA Pro members will get access to the full 10-question version of the video so that they can get a little bit more help and a little bit more understanding. So if you like this and you like our other videos, check out becoming a Pro member. Now with all that, let's dive straight into the questions. All right, here we are at the first question, and as always, I like to point out this strategy if it's available. You want to read the last sentence of a question first, because frequently that's the actual question. That's what you're actually supposed to be doing for the given topic. So you read that first to give you context for what you're dealing with, and then you read the rest of the question so that you know what you're supposed to be looking for. And this is a great strategy for test day. So let's do that here. What amount of goodwill should Premier recognize as part of this acquisition? Okay, let's go up to the top. Premier Corp acquired all of the outstanding stock of Summit Inc. for $2,800,000 in cash. At the acquisition date, the fair values of Summit's identifiable net assets were as follows. Identifiable assets, $3,200,000. Liabilities assumed, $600,000. So again, what amount of goodwill should they recognize as part of this acquisition? Now, this is a fairly simple calculation, but this is kind of an intro question to help us remember how to calculate goodwill in a basic acquisition, because we're going to need to know how to do that, because it is a very good basic first step in learning how to figure out impairment losses and things like that, which we are going to talk about in the next questions. So again, how do you calculate goodwill at the beginning, like right when something is acquired? If you know, that's great. If you don't know, that's okay. We are going to use this question to learn how to do that. So let's go ahead and take a look at the explanation. Okay, here we are at the answer, B, $200,000. That is the goodwill that is going to be recognized as part of this acquisition. So let's go through that. To calculate goodwill, first we have to figure out what the net identifiable assets are. And that's pretty simple. You just take the identifiable assets less the liabilities assumed, and that gives you the net identifiable assets. So $3,200,000 less $600,000 is $2,600,000. Now to figure out the goodwill, we take the purchase price, which was $2,800,000 less the net identifiable assets, and that gets us $200,000. And remember, if you don't know what goodwill is, we're going to explain it very simply right here. This excess amount represents goodwill, which reflects the value of Summit's reputation, customer relationships, or other intangible benefits not separately identifiable. So again, these are identifiable assets. These are identifiable liabilities. You can see them on the balance sheet before the acquisition, but they ended up paying $2,800,000 instead of $2,600,000. So there was an extra $200,000 that they were willing to pay for some reason, even though the net identifiable assets was only $2,600,000. So that extra $200,000 represents something that the company sees as something with value in this acquisition. You know, again, whether it's customer relationships or a reputation of the other company that's being acquired, or whatever the case is, this is stuff that wasn't originally necessarily on the balance sheet as an asset, but it's still something that they were willing to pay extra money for because they thought that it was worth it. And that is basically the goodwill in this situation, the extra money that they were willing to pay, even though it was above the net identifiable assets. So with that, again, that's the basic idea behind calculating goodwill. We're not going to dive super deep into that. That's just a basic question there. Now we're going to talk a lot more about, throughout the rest of the video, about impairment losses and things like that. So let's go ahead and go to question 2. All right, here we are at question 2. What amount of goodwill impairment loss should Ajax recognize? Let's go up to the top. Ajax Corp performs its annual goodwill impairment test on December 31st. The carrying amount of its coastal reporting unit is $3,800,000, including $1 million of goodwill. Based on a recent evaluation, the fair value of the coastal reporting unit is estimated at $3,200,000. So again, what amount of goodwill impairment loss should they recognize here? Now, we learned about calculating additional goodwill in the first question, but that's not really coming into account here. Now we're focused on, is there going to be an impairment of goodwill in the future? So if you know how to do this, it's fairly simple. That's great. If not, though, that's okay. We are going to use this question to learn how to do it. So let's go ahead and take a look at the explanation together. All right, here we are at the answer, C, $600,000. Now let's walk through this to kind of understand what's going on here. Under current US GAAP, which is technically ASC 350, that's the part of GAAP that this falls under. You don't really need to know that. I just wanted to throw that in. So again, basically under US GAAP, goodwill is tested for impairment by comparing the carrying amount of the reporting unit, including goodwill, to its fair value. If the fair value is less than the carrying amount, an impairment loss is recognized equal to the difference, not to exceed the amount of goodwill, and we will deal with that in a future question. So let's just talk about the basic calculation here. So there's the carrying amount, which is $3,800,000. Again, that's the amount that the reporting unit is being carried at currently. And then we take the fair value, which was based on a valuation. This is the estimate, $3,200,000. That's how much they actually think that it's valued at when it comes to market fair value. So the difference there is $600,000. Now, because the goodwill is $1 million, again, that was talked about up here, it's included in the $3,800,000. The impairment loss, which is the $600,000, is less than that, so they can recognize the full, or they must recognize the full $600,000 as an impairment loss. So it's very simple, a very straightforward calculation. You just take the carrying amount, and again, that includes the goodwill, less the fair value that they're estimating, and that difference is the impairment loss of the goodwill. And again, we'll talk about what happens if the goodwill that was included originally is smaller than the impairment loss. We'll talk about that in a future question. But again, this is just a really simple calculation. The difference is the impairment loss. That's all you need to know for that. Now let's go to the next question. All right, here we are at question 3. What amount of goodwill impairment loss should Delmont recognize? Okay, let's go to the top. Delmont Corp tested its Western division for goodwill impairment at year end. The division had a carrying amount of $6,200,000, which included goodwill of $400,000. The division's fair value was determined to be $5,600,000. So again, what amount of goodwill impairment loss should Delmont recognize? Now, we just learned how to do this in the previous question. It's a little bit different in this situation, but I bet you could kind of figure this out logically. Pause the video, think through this, give it a good guess, give it a good try, and when you're ready, come back, we'll look at the answer together. Okay, here we are. The answer is A, $400,000. So that might have been a little bit different than what you were expecting, but again, it's not too difficult to understand once you go over it. So based on what we learned in question 2, now we're just expanding on it a little bit here in question 3. To test for goodwill impairment, subtract the fair value of the reporting unit from its carrying amount. Again, super simple. The carrying amount was $6,200,000. The fair value was $5,600,000. So the difference between those is $600,000, just like in the previous question, just with different numbers. However, impairment loss is limited to the amount of goodwill, which is $400,000 in this case. The additional $200,000 difference cannot be recognized as a loss because it does not relate to goodwill. That's what they're saying anyway. So again, the maximum amount of goodwill impairment loss that can happen is the goodwill that was already there. So even though the impairment loss was $600,000, it actually was only $400,000 of that is attributed to goodwill. So Delmont would recognize a $400,000 goodwill impairment, reducing the goodwill to zero. So the goodwill will be zero now. There's that other $200,000 loss, which is not going to be a part of goodwill. And again, that's the very simple idea. You just compare the carrying amount to the fair value. If the fair value is less than the carrying amount, the difference is the goodwill impairment loss. And the goodwill impairment loss is maxed out at whatever the goodwill was. That's the max that the goodwill impairment loss can be. So in this case, even though it was a $600,000 difference, you can only do $400,000 of goodwill impairment loss because that's how much goodwill was there. So with that, again, very simple. Now let's go to the next question. All right, here we are at question 4. What amount of goodwill impairment loss should Redcliffe recognize? Okay, let's go through this. Redcliffe Corp performed its annual goodwill impairment test for its timber division. The division's financial details were as follows. Carrying amount of the division, including goodwill, $7,300,000. Goodwill included in the carrying amount, $600,000. Fair value of the division, $6,800,000. Value in use, which is the present value of expected future cash flows, is $7,100,000. And the replacement cost of the division assets is $7,900,000. So again, what amount of goodwill impairment loss should they recognize? Now, based on everything we've learned, you might know how to do this, but there's a lot of extra information here. So is it relevant? Is it important? What else do we need to know? Think about this, pause the video, and when you're ready, come back. We'll look at the answer together. Okay, here we are. The answer is C, $500,000. So this was a question just to kind of show you there's going to be some things to try to throw you off, but it's still just the same simple calculation. So let's go through that here. Under US GAAP, goodwill impairment is calculated as the carrying amount less fair value of the reporting unit limited to the goodwill balance. So even though there was all this extra information, this is still the way you calculate it. All that other stuff was kind of stuff to throw you off. Ignore the value in use and replacement cost. They are not relevant for US GAAP goodwill testing. So again, it's just a simple calculation. Carrying amount was $7,300,000. The fair value was $6,800,000. The difference was $500,000, and we know that the goodwill is $600,000. And since the difference is less than the goodwill, all of it can be attributed to goodwill impairment loss. Again, since the shortfall is less than the goodwill, the full $500,000 is recognized as an impairment loss. So this question was actually quite simple. It looked more complicated because there was a whole bunch of extra information, but this was just to show you that in these kinds of questions where you're specifically calculating the goodwill impairment loss, you don't pay attention to anything else besides the carrying amount and the fair value of the reporting unit, and of course the goodwill that was there, because that's the limit for the goodwill impairment loss. So pretty simple question once you realize that it's still the same as the previous questions. Now let's go to the next question. All right, here we are at question 5. Which of the following is the correct journal entry to record this goodwill impairment? Let's go up to the top. Denton Corp determined that the carrying amount of its Harbor division exceeded its fair value by $450,000 as of year end. The Harbor division's carrying amount included $600,000 of goodwill, and Denton concluded that the entire $450,000 shortfall is related to goodwill. Which of the following is the correct journal entry to record this goodwill impairment? So this one's pretty straightforward. It basically is already telling you what the goodwill impairment loss is. You just need to know what the journal entry is. And if you already know what it is, or you already have a good guess about it, that's great. If not, that's okay. We're going to use this question to learn this basic detail that you need to know. So pause the video if you want to. If not, that's okay. We're going to look at the answer together. Okay, here we are. The answer is B. You debit impairment loss, $450,000. You credit goodwill, $450,000. Pretty simple. Let's go through this. When goodwill is impaired under US GAAP, the loss is recognized in the income statement, and the carrying amount of goodwill is reduced. So the impairment loss is debited because that's an expense, and you credit goodwill to reduce the goodwill asset. That's the basic journal entry that you do here when you have an impairment loss for goodwill. This journal entry does not involve a sale, so C is wrong. It does not affect other comprehensive income, so D is wrong, and A reverses the debit credit direction. Again, you debit impairment loss, you credit goodwill so that the goodwill is reduced by that goodwill impairment loss. So again, very simple. The concepts throughout this video have been pretty straightforward. You might not have known it until you saw it, so now you know how to do it. Now, before we do anything else, let's do one more part of the SuperFast CPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material in your review course, you will notice the things that keep popping up. You've seen 2 or 3 or 4 questions trying to teach you how to calculate impairment loss for goodwill, or whatever the case is. Again, you notice these things throughout the questions, and so you take a moment and write them out in your own words as the pillar topics, the most important things you learned from the questions. And as you are doing this each day, you are building your own personal repository of the most important things you learned from the questions in your own words so that you are prepared when it comes to the exam. So with that, let's go ahead and take a look at the pillar topics for this video. All right, here we are at the pillar topics, just a few of them this time because it's a very straightforward concept. Goodwill is initially recorded as the excess of the purchase price over the fair value of identifiable net assets. To calculate goodwill, subtract the fair value of the acquired company's assets minus liabilities from the total consideration transferred, because again, goodwill would be the additional amount that was part of the consideration that was over the net realizable assets or net identifiable assets. A goodwill impairment loss is recognized when the carrying amount of a reporting unit exceeds its fair value limited to the recorded goodwill. The impairment loss is the lesser of the excess or the total goodwill balance. Again, that's basically another way of saying that the impairment loss is limited to the total amount of goodwill. And then finally, the journal entry for goodwill impairment includes a debit to impairment loss and a credit to goodwill. This reduces the goodwill asset and records the expense in the income statement. Again, very simple concepts, very simple ideas in this video, very straightforward once you know it. So now you know how to do goodwill impairment, and that is it for this YouTube version of the video. Remember, in today's video, we only went over 5 questions, but SuperFast CPA Pro members will get access to the full 10-question version of the video that I'm about to finish after this in the member forum. So if you like this and you like our other videos or our other material, make sure you check out becoming a SuperFast CPA Pro member to get access to these full 10-question versions of the videos so that you can get a little bit more help and a little bit more understanding. And the easiest way to learn about and become a pro member is actually by going to SuperfastCPA.com and signing up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam. And after that, again, it will give you a good path to learning about and becoming a pro member. So check out the webinar, check out becoming a pro member. Now, if you liked this video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.